Hi traders, welcome to the weekly recap, just to take you through what's happened this week with our current options spread and our strategy with the futures, which is hedging this spread. So if you remember, we're back here on the 21st was our last trade when we did an update, and that was triggered in short here on the red arrow at 11:28, 11:29ish, so 11:28.75. So all we had to do was bring our stop down, our stop that was hedging against these the option spread. So we just keep bringing it down on these yellow dots. So as the yellow dots appear, that's where our stop goes. So we're in this short trade, we're taking profit all the way down on the swing low, and we get down here and we're out at this area here where the yellow dot is. So in that one move alone, we take 17.5 points. Now that means each $100,000 spread, so per $100,000 you put on one spread, and that spread is a spread that you get when you join as a member. We give you the fundamentals of how that spread's set up, and then we help you set that. So at the moment we've got a spread set on a $100,000 account. We've also got another 5 set on a $500,000 account, so we're tracking both. And look, we made 17.5 points on one spread. So if it was 5 spreads that you had on at this time, you're making 5 times 17.5 points in this one move down. So then we're looking for another trade because we just got stopped out there by 0.25. Like, some members may not have moved their stop quick enough and they'd still be in this trade, but I got stopped out, so that's where we're at. See, the yellow dot is a stop, so it was 11:25, and the high of this next candle was 11, so 0.25 we got stopped out of that. So not everyone would have got stopped out, but I did. So now we're looking for another trade. So we've just come out of a short trade that got us 17.5 points. Now we're looking for another one, either a long or a short. Long for green, short for red. We get triggered into another short here, this red cross. So we come down and we put our marker there just so we can visually track this. As soon as we trigger in, the yellow stop comes up. That means that you should be in the trade, and we're just moving our stop down as those yellow dots appear. That's our stop. So we're going over the weekend break with another. So we triggered in 11:03.25 and we're down to 1100.25. So back down to this 1100 level where we were last month, and we'll just have to see how it goes. Currently short, so we'll just update the spreadsheet so you know where we're at. So that last trade was a 17.5 point move. So per $100,000 you're making, or $100,000 means you've got a spread on. So every spread means that you've got $100,000 in your account, which means you can do your 5E minis per futures trade. So that's what we've made in those last 2 moves. On a $100,000 account we've pulled in 5 grand. So we're back up to 3.2% for the month. We've still got another 27 odd days until expiry. So this is all we do. We set our spread and then we just monitor the futures. We're taking our futures as the system tells us to, and we wait for that big move. So we chopped in and out of the trades. We're down 3 points there. Add those together, down 2 points. So all we're doing is sort of hedging our spread. We're down 8, down 9, down 16, and then bang, we're back up in front again. So we add that futures profit to our options, and that gives us our percentage for the month. So 3.2% at this stage with an open short position, and that's just a really good example of how you make money while you're waiting for your spreads to expire, while you're hedging your futures, and you're just going short and long, and you're just trailing down with your stop, and you're making money while you're waiting for the options to expire, and that's called the hedge. So thanks for joining us, and I'll do another recap after Monday's session.